Welcome to our new IFRS Educational Service. It's an initiative of OJ Inspiration Limited. It is dedicated to providing complementary and supplementary education on international financial reporting standards IFRS through a multiple choice question and answer approach. It is intended to make learning verification, mastery, and intellectual assurance fun. In this session, we shall be considering cumulative set 210 questions to which the answers will be provided on IAS 32. This is standard of financial instruments presentation. Viewers and subscribers have 30 seconds to select or choose the answer to each question. The answers to the cumulative 10 questions are reviewed at the end of all the questions. Please enjoy it. Question number 11. A financial instrument that is automatically put back to the issuer on the occurrence of an uncertain future event is called A, compound financial instrument, B, settlement option, C, putable instrument, D, contingent settlement provision, P, equity instrument. Some counts. Time seconds gone. Twenty seconds gone. Time up. Question number 12. Which of these is not a feature of derivative financial instruments? A, credit rights and obligations. B, involve conditions that are potentially favorable or unfavorable. C, they are primary instruments. D, transfers of financial risk are involved. E, originate on underlying primary instruments. Some counts. Ten seconds gone. Twenty seconds gone. Time up. Question number 13. Compound financial instruments from the perspective of the holder is dealt with by A, IAS 39, B, IAS 32, C, IFRS 7, D, IFRS 9, E, IAS 28. Some counts. Ten seconds done. Twenty seconds done. Timer. Question number 14. Which of these is not a financial liability? A, putable instrument. B, note payable. C, redeemable preference share. D, deferred tax liability. E, debenture. Some counts. Time seconds done. Twenty seconds done. Time up. Question number 15. A putable instrument that subsequently ceases to meet all the features of a putable instrument but still exists is A, reclassified, B, derecognized, C, remeasured, D, presented in the notes, E, not disclosed in the face of the financial statements. Some counts. Ten seconds done. 20 seconds done. Time up. Question number 16. One of these holds about IAS 32. A, it has provision for hedge accounting. B, it also provides basis for impairments. C, it deals with treasury shares. D, it does not deal with offsetting a financial asset and a financial liability. E, it does not deal with the presentation of a financial liability. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 17. In offsetting a financial asset with a financial liability, the amount presented in the statement of financial position is presented A, gross, B, net, C, gross or net, D, nil, E, without netting impairment. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 18. Which one is the odd one out? A, IFRS 9, B, IAS 32, C, IAS 33, D, IAS 39, E, IAS 32, and IAS 39. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 19. In the transfer of a financial asset that does not qualify for the recognition, the entity A offsets the transferred asset and associated liability. B recognizes the associated liability. C recognizes the associated liability when the asset is derecognized. D recognizes additional liability. E does not offset the transferred asset and the associated liability. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 20. One of these standards does not involve equity instrument measurement or remeasurement. A, IAS 27, B, IAS 28, C, IAS 29, D, IAS 32, E, IAS 37. Time counts. 10 seconds done. 20 seconds gone. Time up. We proceed to review the answers. Question number 11. The answer to question number 11 is C, putable instrument. Putable instrument is a financial instrument that gives the holder the right to put the instrument back to the issuer for cash or another financial asset, or is automatically put back to the issuer on the occurrence of an uncertain future event or the death or retirement of the instrument holder. C is the answer to question number 11. Question number 12. The answer to question number 12 is C. They are primary instruments. Derivative financial instruments are not primary financial instruments. Rather, they arise for the effecting of transfer of financial risks inherent in underlying primary financial instruments. They come into existence as a result of risks associated with underlying assets or underlying liabilities, hence the name derivatives. C is the answer to question number 12. Question number 13. The answer to question number 13 is D, IFRS 9. IAS 32 financial instruments presentation deals with compound financial instruments from the perspective of the issuer. With respect to compound financial instruments from the perspective of the holder, it is dealt with by IFRS 9 financial instruments. D is the answer to question number 13. Question number 14. The answer to question number 14 is D, deferred tax liability. Deferred tax liability is not a financial liability. It is not a contractual obligation and is not a contract that will or may be settled in an entity's own equity instrument as a non-derivative or a derivative. D is the answer to question number 14. Question number 15. The answer to question number 15 is A, reclassified. An entity reclassifies putable instruments from the date when they cease to meet all the conditions or are no longer having the features of putable instruments. They are reclassified as equity instruments. A is the answer to question number 15. Question number 16. The answer to question number 16 is C. It deals with treasury shares. IAS 32 financial instruments presentation deals with treasury shares which are own equity instruments. Treasury shares are deducted in arriving at the current amount of equity. C is the answer to question number 16. Question number 17. The answer to question number 17 is B, net. When the conditions for the offsetting of a financial asset and a financial liability are met, it is the net amount that is presented in the statement of financial position. B is the answer to question number 17. Question number 18. The answer to question number 18 is C, IAS 33. IAS 32, 39, and IFRS 9 are all financial instrument standards. IAS 33 earnings per share is not a financial instrument standard. C is the answer to question number 18. Question number 19. The answer to question number 19 is E, does not offset the transferred asset and associated liability. In accounting for a transfer of a financial asset that does not qualify for the recognition, an entity does not offset the transferred asset and associated liability. E is the answer to question number 19. Question number 20. The answer to question number 20 is E, IAS 37. IAS 37 is a standard which deals with provisions, contingent liabilities, and contingent assets. It does not deal in any form with the measurement of equity instruments. IAS 27 separate financial statements, IAS 28 investments in associate and joint ventures, IAS 29 financial reporting in hyperinflation economics, and IAS 32 financial instruments presentation all deal with equity instrument measurements or remeasurement in one way or another. E is the answer to question number 20. That is all for this set 2. Thank you for joining us for the set 2 of IAS 32 Financial Instruments presentation. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all other subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of questions and answers on standards already covered. For collaboration in this area, please call or WhatsApp +2349 030 770109. All rights to this production and others in the series are reserved for OJ Inspection Limited. Thank you once again, and bye for now.